So the general outlook is for the cap to decline slightly as we move later into 2025. However, as we're seeing today with the wholesale market, there's still the potential for a lot of volatility. So there's unfortunately a lot of uncertainty before we start to see those numbers actually crystallize, hopefully lower numbers crystallized in household bills.
OK, Craig, thank you very much for that. That's Craig Lowry there from Cornwall Insight on the energy bills. And we're expecting an official announcement on the cap this coming Friday. Craig, thank you for your time. Now, motor industry bosses are expected to warn the government this week that sticking with its targets for electric vehicles will put thousands of jobs at risk. At the weekend, the Transport Secretary, Louise Haigh, insisted the targets wouldn't be relaxed, but she did say that ministers could create what she called new flexibilities to help manufacturers. Let's speak to Ian Plummer. He's Commercial Director at Auto Trader and joins us this morning. Ian, very good morning to you. What are the concerns within the auto industry about these targets? Just talk us through them. It's a bit complicated, isn't it? But essentially, there is a sense that the motor industry is not going to meet the targets this year, and that means financial penalties, doesn't it?
Well, the targets are very tough. Each manufacturer is expected to achieve 22% of their sales as battery electric by the end of this year. That then ramps up to 28% next year and goes all the way up to 80% in 2030. And having had the recent government announcement in the budget that we will be ending sales of petrol and diesel cars, after 2030, it'll presumably only be battery electric or plug-in hybrids we can sell through 2035, when then again, plug-in hybrids end. So there's a journey, if you like, all the way through to 2035. But on that journey, if you don't hit your respective numbers, 22% this year, rises to 28 next year, then you pay a fine of £15,000 for every car sort of beyond the target that didn't get there. So that can add up to millions of pounds of fines for a particular manufacturer. Currently in the UK, the overall market is running at 18% of battery electric. Now, some brands are pure electric, Tesla, for example. So other brands, you can imagine, are quite significantly below that 22%. There are some flexibilities within the system already. So there are some abilities to catch back what you don't do this year, but you pay a sort of interest on what you don't do this year if you catch it back next year. You can buy credits from a competitor, such as, let's say, Tesla, who's already made a lot of money in that field in various markets where that kind of mechanism exists. But in essence, it is a very hefty stick to encourage the industry to get the consumer on this journey. Now, what we can see is the consumer wants to buy electric, but there is a challenge in getting enough of them on this journey. That's why we've launched a program today to try and create more certainty and clarity in the mind of the consumer on that journey to 2035.
And Ian, why, I suppose the big question is, why are these manufacturers not meeting those targets? Is it consumer demand, or is it a problem with supply chains, a lack of desire? Why is it?
Firstly, design, though. I mean, I've been lucky enough to try a whole host of EVs that are on the market in my position, and every single one has been fantastic to drive, smooth, quiet, accelerating very well, etc. The technology in them is amazing as well. So I challenge anybody to get inside an EV and not enjoy the drive. The vast majority of people, as many as 9 in 10, most surveys say that they would never go back once they've had an EV. So it's not the ownership experience. The buying experience is expensive. There have been issues of range and charge that have got in the way. The charging industry has really got behind that challenge, though, and there are more than 70,000 chargers in the UK now, public chargers. Many people can charge at home. Around 2/3 of people could have a home charger. If they do, that removes an awful lot of the charging issues, and then they will get a lower cost of running their vehicle than they would do if they've got a petrol car. The starting price of the car, though, remains a problem. Now, to your point about whether that's a demand issue, I'd challenge that it's probably a reflection of the demand at a given price. In other words, a new electric is around 30% more expensive than its petrol equivalent. Therefore, it slows the demand. When they're priced more aggressively, and in used cars, they're now at parity to their petrol equivalents, they sell extremely well. They're the fastest selling segment on our site, in fact.
And just very finally, Ian, I mean, are you in favour of these targets? Do you think they're fair, or do you think the government actually does need to give some grounds?
Well, I think the industry recognises the need to work towards a clean transport system, a sustainable mobility, I beg your pardon, is an ambition that I think everybody in the industry subscribes to, and we certainly do. The route of the route we're on, the direction of travel is therefore not a debate. I think there is a debate around the incentivization. I've talked about the stick. There could be potentially more carrots to help the consumer get there. In many other markets, consumers have received other incentives to go with the stick that the industry has right now.
Okay.
The combination would probably be useful.
Okay, Ian from Auto Trader, thank you very much indeed for joining us. Well, let's get another point of view now. Let's bring in Fiona Howarth. She is Chief Executive of Octopus Electric Vehicles. Fiona, I assume that you do agree with these targets and think they're a good idea and that they can push the industry in the right direction?
Hi, Darren. Yeah, absolutely. We are seeing such an explosion of amazing cars hitting the road. And we see that UK drivers want affordability, they want great range, and also they want a growing charging infrastructure. The ZEV mandate is bringing all of those things. So actually we can have cars as cheap as £15,000 now, electric vehicles. Some of them that we're offering on salary sacrifice is $199 a month, including insurance. So they're really affordable. And there's now over 100 different types from 30 different manufacturers. Such a great range. And then the other thing the ZEV mandate, the regulation has been doing, has really been giving confidence to the charging manufacturers to install those charge points at pace, giving confidence to all EV drivers wherever they might be going. But of course, as Ian just said, many people can charge at home, and then it's 6 times cheaper for the fuel than what they'll be paying for their petrol today. So we're absolutely seeing there's a lot of options. And, the regulations are really doing what they need to bring affordability and choice.
Do you accept, though, that some of the price points, particularly the initial cost for lots of consumers, clearly is acting as a deterrent? I mean, these figures aren't being reached for a reason.
So actually what we are seeing is that the car manufacturers as a collective are on track to be able to hit their targets this year. So actually they are on track to hit about 90%, which is what they need. They need just over 18% on average when you look at the kind of details of the regulation. So actually this year they're going to be fine as a group. What we do see, however, is that some of them are doing really well, and there are some laggards. Those laggards have underinvested in the EV transition, and now they're struggling. And what we also see, though, in the UK is that 80% of the cars that we make here are for export. So what we do need to do is to think about how do we create a UK which is really built for the future of the car market, not kind of look after those laggards that haven't kept up with us on that journey. And so how do we position it
Fiona,
so that we're really well positioned for future?
You call these companies laggards, and they may well be in this particular field, but they do employ people in this country, and they and the unions are concerned that this entails a cost and could see job losses. That's clearly not good.
We absolutely want to have a thriving industry here in the UK that employs many, many people, and that industry is going to be in the electric vehicle space. The global market is going electric. 1 in 5 cars this year are going to be electric sold globally. Already in China, we're seeing that 50% of new cars there are electric. And therefore, we really need to embrace this future so that we don't, as Britain, get left behind.
OK, Fiona, really appreciate your thoughts on that this morning. It is an ongoing discussion. As I say, the Minister is meeting with the unions later and the manufacturers this week to see if there are going to be further flexibilities in that target. But for the time being, Fiona Howarth from Octopus, thank you very much.
Thanks, Darren.
Now, the UK and German Business and Industrial Parks Group, Sirius Real Estate, says it has a positive outlook for the economy as it posted its half-year results this morning. The company reported an 11.7% increase in total revenue to €156.5 million. Well, let's talk to the Chief Executive now, Andrew Coombs, who joins us. Very good morning to you, Andrew. So profits are up. Why?
Well, morning, Darren, and thank you very much indeed for having me on this morning. Sirius, as you know, operates in Germany and the UK, and we own and operate industrial business parks on the edge of key cities in the UK and Germany. And what we've been doing over the period in question, the last 6 months, is we've been working very, very hard to supply the services that are good for our customers. In return for that, we've been able to grow our rent roll by just over 5%, which has resulted in some increases in valuation. So we have grown the business, both in terms of its operating income as well as the value of the properties.
And that's a sign, some might say, of a healthy economic background. But actually, when you look at both the two markets you operate in massively, the UK and Germany, that doesn't seem to be reflected on a macro level, when you look at the stats, I mean, the German economy effectively has not grown over the last couple of years, and our growth seems to have stalled here.
Look, I wouldn't disagree with that. And as you know, somebody who works with a management team who lead a business, you know, what we seek to do is to be able to provide good value to our customers in order to reflect good value for our shareholders. And you know, often what that means doing is, despite the conditions in the market, look at ways whereby we can serve our customers better and produce better returns for our shareholders. And we've had to work very hard to do that over the last 6 to 12 months in both the economies in question.
And you say about providing your customers with a better service. What does that look like? What does that mean, Andrew?
Well, firstly, it means staffing our business parks so that we are there and in contact with our 10,000 or so tenants on a daily basis. What that means is that we concentrate on running the property so they can concentrate on running their business. The way in which we help with them running their business is not just providing them the space to run it from. We also provide telecoms. We provide, you know, utilities, electricity, gas, etc. 30% of our tenants are actually in manufacturing industries. So there's a whole range of services that they require, whether that be, you know, Airbus in Munich building carbon fiber wings for the Airbus airplanes through GKN, or some of the people that are involved in the car industry in places like Banbury, where our UK brand BizSpace operates.
And just in terms of coming back to kind of the wider economy again, I mean, are you concerned with the prospects here in the UK and in Germany? You know, there's a lot of headwinds ahead. We've got tax increases here at home, the potential of tariffs imposed across Europe by a new Trump presidency. It could drag economic growth down further, couldn't it?
Well, let's start with the UK. I'm very concerned. I'm very concerned, you know, in terms of the inflationary nature of the budget. I'm very concerned in terms of increased employers' national insurance. I'm yet to understand what the new workers' rights bill might entail. All of this puts an additional burden on small and medium-sized businesses, which is our core market. All of this makes it more difficult for those businesses to have the certainty they need to be able to operate in the future. If I turn to Germany, where, as we all know, the elections due in September of next year have been brought forward to February, that is almost certainly going to result in a change of government. As we know, Germany has the biggest balance sheet in Europe. The new government should be able to unlock that balance sheet. That will mean a number of different things, including giving Germany the ability to introduce fiscal stimulus to help the German economy. So I'm concerned in both cases, although I can see how Germany over the next 6 months could end up being in a better position than the UK.
OK, well, we will wait and see. Andrew, live there in the city. Thank you very much indeed. Andrew Coombs there, the Chief Executive of Cirrus Real Estate. Thank you for your time this Monday morning.
Thank you.
Now, the average price tag of a newly marketed home fell by more than £5,000 in November, according to the property website Rightmove. Across the UK, the typical asking price for a home coming onto the market is £366,592. That's down 1.4% or £5,366 month on month. It is the second month in a row, the growth has been weaker than usual, according to Rightmove. OK, you're watching Business Live on this Monday, which is a quick break. Coming up next, we'll be looking at the markets. The FTSE up just a smidgen this morning, with the details of that and the rest of the market news. Just a couple of minutes. Stay tuned.
I'm David Blevins, and I'm Sky's Senior Ireland Correspondent.
It takes 60 minutes to cross the Irish Sea. It took the British monarchy a century.
I've spent 30 years reporting the journey from conflict to peace.
The political parties of Northern Ireland have reached agreement.
If there's anyone who might know how to fix Northern Ireland's devolved government, it's the American architect.
Changes in circumstance require changes in approach.
The end of the political stalemate, the start of a new chapter for Northern Ireland.
I confirmed that I am willing to take up the office of First Minister. My election to the post of First Minister demonstrates the change that's happening on this island.
Catholics and Protestants on different sides, now facing the same threat.
If we both contract COVID-19 and end up in hospital, religion's nothing.
People here are adept at finding hope amid adversity. That's the spirit of a place that punches way above its weight. We help you understand the world with us. A toxic blue-green algae now poisoning Lough Neagh. It's breaking your heart what has happened here.
It is.
This is a vital resource, a national treasure, now fighting for its very life. They are effectively surrounded by Northern Ireland, and that makes this the most unlikely of international frontiers.
If there's a hard border, I think it'll cripple the country.
Winter is coming. Welcome to Winterfell. It's an iconic location in this globally acclaimed drama. Ophelia was the most powerful hurricane this far east in the Atlantic on record. Sky News, the full story first.
Our app gives you the very best of Sky News wherever you are. Breaking news, videos and analysis.
Evidence of the crisis.
Podcasts, watching us live. I'm live in Jerusalem.
Wherever you get your podcast.
All in one place and all at just the touch of a screen. The Sky News app. Get the full story first.
Very welcome back. Let's have a look at the markets on this Monday morning. And Asia-Pacific stocks are mixed, as you can see. A quiet week for economic data across the region. Japan's markets were the outlier, though, with the benchmark Nikkei down 1%, dragged on by a decline in technology shares. European shares have also been pretty flat this morning, though mostly down as investors wait guidance from policymakers on interest rates this week. Here in London, the FTSE is trading up just ever so slightly. Shares in the aerospace company Melrose Industries surged 6% this morning after it reported a 7% rise in profits in the 4 months to the end of October. Meanwhile, Burberry also doing well today, continuing on from last week's rally after it revealed a plan on Thursday to boost waning sales by refocusing on its heritage designs and statement pieces. Let's look at the currency, and the pound is currently just down against the dollar there at $1.26. It's lost quite a lot of ground against the US dollar in the last 2 weeks or so, partly not great economic news from us here with GDP figures, etc., and also partly a strengthening dollar off the back of Donald Trump's victory, though it's maintained ground against the euro there at €1.20. And let's look at the Brent crude this morning, hovering around again the $172, $171 for a barrel of Brent crude, up 0.5% this morning. Let's speak to Ross Mould. He's Investment Director at AJ Bell. Very good morning to you, Ross. Let's start, if we can, with Melrose, doing pretty well this morning.
Good morning to you, Darren. Yeah, the numbers have gone down pretty well, as you say, with that 7% increase in profits, and that's enough to get the shares to the top of the FTSE 100 leaderboard today. Some saw the July numbers as being a little bit disappointing, even if there were no actual downgrades there. And I guess the company is still flagging there are some challenges with supply chains in the aerospace engine business. We know what's going on at Boeing. We know that Airbus is, even with its massive backlog, is struggling to get some of these pieces of equipment out of the door on time. So there is still a bit of a knock-on effect there. But what's really carrying Melrose at the moment is the aftermarket for those engines, servicing them, keeping the birds in the air. That business is up about a third year on year, and it's obviously going to be a very high margin business as well. So that's carrying the company forwards right now.
And let's talk about Boohoo, because the opposite's happening there, isn't it? Investors really shunning the online retailer.
Yeah, I mean, it got the £39 million it was asking from investors, but it was institutions that stepped up. Private retail investors shunned the issue. They were given a chance to buy a few £1 million worth of shares and bought less than 10% of what was available to them. Partly perhaps because they were offered the shares at a premium to the available price in the market. So why would they have done that? They could have just simply, stepped in and used their stockbroker to get a market price. Maybe there are still deeper questions there. Clearly, the share price chart isn't very pretty. It goes from top left down to bottom right, and it's down no more than 90% from its highs. And there are questions over the company's model, both specifically and in terms of fast fashion, given supply chains and the scrutiny that's being applied there now.
Indeed, though, when you look at the competition, if you like, and big competition, Shine could be floated, and it's been doing incredibly well.
I mean, that may be part of Boohoo's problems. You know, if you look at what unseats any company over time, it's competition, customer disaffection, or regulation. And Boohoo's got no shortage of competition, and Shein has come through out of the clouds in the past 2 or 3 years. It is reportedly moving towards a first quarter listing on the London Stock Exchange next year. Some people will be thrilled to see a big, global, fast-growing brand come to London, a big affirmation of London's charms. Some may be more concerned, and the fact that they actually filed for a flotation, about a year ago, and still haven't got around to it, suggests there's still a lot of scrutiny on corporate governance and again on supply chain. So institutional investors and retail investors, if they get the chance, will be able, through all the paperwork and prospectuses, to have a very, very close look at the company before they put their capital at risk.
And talk to me, if you can, Ross, about the dollar. We've been tracking it quite closely here on Business Live for the last couple of weeks. Frankly, if you're potentially hoping to go to the US and do some Christmas shopping, now is not a good time, isn't it? It's lost quite a lot of ground over the last 3 weeks or so.
Yeah, the dollar's been extremely strong. A lot of that is in really, I think, markets latching on to Donald Trump's pro-growth policies, which could be seen as a good thing for America. But equally, it means that if inflation is stoked because tariffs make goods more expensive for Americans, because onshoring makes things more expensive for Americans because it just costs more to employ people in Chattanooga than it does in China, that may mean that the US Federal Reserve can't cut interest rates as quickly as markets had thought, and higher interest rates on the dollar will probably attract money into the American currency. The big question is, how far does the buck go? And there is a professorial paper from the 1960s saying actually the world needs a weaker dollar because it is the global reserve currency. And if dollars flow back into America, that drains liquidity from financial markets, drains liquidity from the global economy, and could actually be a bad thing. It's known as the Triffin dilemma. So perversely, if Trump succeeds in what President-elect Trump succeeds in what he wishes to do, he may do more damage than he thinks elsewhere if Professor Triffin is right or was right.
OK, Russ, great analysis as always this morning. Russ Mould there from AJ Bell with the latest on the market on this Monday, and that very, very strong dollar indeed. Thank you very much indeed, Russ. That is it from me for Business Live for today. I'm back, of course, at 4:30 this afternoon. Coming up next, it's the very latest news headlines with Steve Barlow, including the visits by the Prime Minister to Rio de Janeiro and the G20. The Prime Minister expected to meet Xi Jinping, the Chinese Premier, the first time that has happened in 6 years. Gareth with the very latest on that at midday. I'll see you a little later on this afternoon. Thanks for watching.
This is Sky News Today. It's 12 o'clock. The headlines this hour. Warning to the West. The Kremlin reacts to Joe Biden's decision to allow Ukraine to use long-range US missiles inside Russia. The Prime Minister sets his sights on a pragmatic relationship with China as he meets President Xi at the G20. Tottenham's Rodrigo Bentancur is banned for 7 matches after using an alleged racist remark to discuss his South Korean teammate. Police strip searches. Greater Manchester Police make a change following an investigation by Sky News home editor Jason Farrell. Weather warnings. The UK braces for snow, ice and power cuts in Scotland and Wales, and Northern England will tell you what to expect. Very good afternoon to you. The Kremlin has warned that any decision by Joe Biden to allow Ukraine to attack targets inside Russia with US long-range missiles will lead to a rise in tension and deepen America's involvement in the conflict. It comes as Russian attacks on Ukraine intensify. Overnight Russian strikes on a residential building in the northeastern city of Sumy killed 11 people, and another 8 have been killed after an airstrike in the southern port city of Odessa. So let's take a look to consider what we know about the US-supplied missiles. Well, the Army Tactical Missile System, commonly known as ATACMS, are some of the most powerful so far provided to Ukraine, capable of travelling up to 186 miles. They were provided by the US for the first time last October. Ukraine